The stock market has been booming since January. I mean, the S&P index shows a 13.5% increase, which means your shares have probably brought you some considerable gains. Or there's also that possibility that you've lost a ton of money in crypto, especially because crypto isn't doing so well. I'm just waiting for Elon Musk to make that tweet. Come on, man, just give us some love. Either way, it helps to know how tax works on shares in Australia. What's up, tax fam? So we've spoken about tax on cryptocurrencies, but how does tax work on shares in general? Well, that's why I'm here today. The ATO has a complex set of rules for taxation on shares. These are not always easy to understand and you can be hard to keep track of as well. But it's super important that you get your tax right, because if you don't, you could end up paying too much tax or even too little tax on the sale of your shares. That means less money in your pocket or you're rorting the government. So let's just jump straight into it. You need to pay tax on any profits that you've made from buying and selling shares during the year. So if you've acquired shares at a particular price and then you sell it for a higher price, then you've realized a capital gain on the sale of those shares. For example, if you've purchased shares for 1.2k and sold them a few months later for 2.2k, the capital gain realized will be $1,000, and you will need to pay tax on that gain. The $1,000 net capital gain gets added to your assessable income for that year, and you'll be taxed according to your marginal tax rate. So if you get paid a salary of $49k and you made that $1,000 gain from trading shares, your total taxable income is $50k. Dividends are also included in your total taxable income. In fact, the ATO will already have that information and what you've earned through dividends throughout the year. So that will be automatically added into your income in your tax return. But it's super important to note that there are quite a few factors that influence your CGT liability when it comes to buying and selling shares. The first one is whether you hold the shares as an investor or trading shares as a business. There are different tax implications depending on how often you trade shares and whether you can be classified as a share trader for business purposes. So what exactly is an investor? Well, according to the ATO, if you hold shares to earn income, then you're considered a shareholder. But that income isn't necessarily ordinary income. In other words, it's not money you earn on a day-to-day basis like your salary. It's simple income as a result of share value increasing. So you have to pay capital gains tax. The capital gains tax on shares will be added to your annual income return and you'll be taxed at the marginal tax rate. Let's look at Sophia, for example. She bought 890 shares in Rose Limited for $1,380, including brokerage fees, and sold them for $2,535, plus $62 in brokerage fees. She simply held on to the shares and then sold them when the price was higher. So to work out her capital gain, she has to take the price she sold the shares for, $2,535, minus the price she bought them for $1,380, plus $62 of brokerage fees, and that's your capital gain of $1,093. You'll need to know that even if you've gifted the shares and eventually sell them, you'll also have to pay capital gains tax. And if you gift shares to another investor, you have to pay capital gains tax if you've made a capital gain at the time you gifted the shares. For example, Chloe bought 1,800 units in a share trust for $2,645, including brokerage. As a gift, she then decided to gift the units to her sister, but at that time she gifted them, the shares were actually worth $3,000. So Chloe has to pay capital gains tax on the $355 gain. Another event that triggers capital gains tax on shares is when there's a change of ownership of an investment and that the change is involuntary. For example, if the company that you hold shares with is bought by another company or merges with another company, the sale or merger could end up causing you to either make an involuntary capital gain or loss. If you make a capital loss because the shares are worthless or cancelled, you can offset that loss from other capital gains during the year. So you can actually offset your capital loss against other capital income, but just not other income like your salary. Now, we've given you a few examples of how capital gains tax is calculated for investors, but there are a few types of concessions available to investors when calculating capital gains on your investments. There's one concession that I want to mention in this video, and that's the CGT discount. So if you've held your shares for longer than 12 months before you sell them, you qualify for a 50% discount. So if you've used this concession, you can save a whole lot of money. You basically can halve your taxes on the capital gain if you hold the shares for more than 12 months. But yes, a lot can happen in 12 months. I guess it's a way for the ATO to encourage people to invest. Okay, so that's everything you need to know about the tax on shares as an investor when you incur a capital gain or loss. Let's jump to the tax implications for share traders. The ATO defines business for tax purposes as a money-making venture where you're not an employee. So if you're buying and selling shares on a daily basis to earn income, you'll probably fit into the share trader definition. But there are no black and white rules about who is a share trader and who isn't. The ATO simply gives some guidelines to work with. The ATO assesses the nature of your trading activities and your business or the trading plan when deciding. This information includes how often you trade, why you make certain trade decisions, and assess the potential investments as well. So if your business activities are carried out to generate a profit and you buy and sell shares as part of your business routine, then you're probably a share trader, especially if you keep annual reports of your progress. Let's take Alexa for example. She studied marketing and ventured into freelancing work. But after chatting to some of her investor friends, she decided to look into share trading. She saw a ton of prospects in trading shares and ended up investing $120,000 of her own, $80,000 of her savings and $40,000 from a lending facility. She cut down most of her freelancing hours, decided to focus on her trading and conducted daily market analysis from various sources. After 8 months, Alexa had made about 54 share transactions, 32 share purchases, and 22 share sales. So after considering the ATO's guidelines, Alexa has definitely demonstrated a profit-making intention, especially since she's cut down her freelancing hours to focus on making money through trading. And her daily work routine involves share trading activities and research. So for tax purposes, Alexa is a share trader. This means that she can claim any gains from the share market as her personal income and any expenses and losses as a tax deduction. The biggest benefit for Alexa is that she can claim these business tax deductions, which the investor we spoke about earlier couldn't. So just like running any other business, Alexa can claim business deductions for the cost of buying and selling shares and claim rent expense if she has a specific room where she does her share trading from. She can also claim computer equipment expenses, subscriptions, consulting expenses, and any other type of business-related expense. But unfortunately, she won't be eligible to claim the 50% discount as her trading activity is not considered capital gains. Having said that, if you're a share trader operating as a business, there are a few ways that you can structure your business so that you can save on taxes in other ways. For example, you could set up as a company or operate through a trust. Each option has its own tax benefits and downfalls. So it's best you call up an accountant to give you some advice on the best structure for your business for saving tax. Or you can watch the video up here. So before I jump off, here's a quick recap. If you're a share investor, any net profit you make from your investments are subject to capital gains tax. You can't claim the purchase price of shares as a tax deduction, and capital losses are subtracted from capital gains. If you're a share trader, you're basically selling and buying shares as a business. The money from the sale of the shares and share dividends are included in your assessable income, and the cost of buying and selling shares can be claimed as a tax deduction. If you have any questions about share tax, leave them in the comments below. Otherwise, that's it from me. Make sure to like and subscribe for more accounting tax tips. Until then, let's hope that Elon Musk tweets some really good stuff for us to make some really good gains. See you guys soon.